This is not a sponsored video. Before you move ahead, please make sure that you read through the disclaimer shown on the screen. Today we're going to be talking about Bharti Axa Life's Elite Advantage Plan. This plan offers guaranteed payouts of 8.5% to 9.5% from the end of policy term and 100% sum assured at maturity. So that means that it is giving you two type of guaranteed income. One is a regular income and the other is a lump sum that you will receive at the time of the maturity of this particular policy. Now, the first thing is that how is the company able to give you guaranteed returns? The reason why you are getting guaranteed returns is because this is a non-linked and a non-participating policy. A non-linked policy means that a part of your premium, which is used for investment, will not be invested in stock market instruments, which means that there will not be any volatility in the returns that you will be getting. Non-participating means that this particular extra premium will also not be invested and you will not be participating in the bonuses that the company is going to be declaring over time. Since you will not be having the volatility that either the bond market or the stock market offers, hence your returns are going to be guaranteed, which will be told to you upfront at the time of taking this particular policy. Now, what's the red flag? How is the company able to give you 8.5 to 9.5% of return? Because the small caret sign over here, if you just follow it, it says the guaranteed payout is a percentage of sum assured at maturity. So when somebody calls, like many of you, I will have also received the call that this particular plan is giving you 8.5 to 9.5% of returns. It's actually a percentage of sum assured at maturity. And how that is calculated is not something that the company has covered in this particular presentation. So let's move further and try to find out some of the basics about this particular plan. So I'm reviewing this today, and why it is important to call that out is because the plan has a plan code of what you can see on the screen, and with time there are small modifications that the company does on this plan, and hence I want to make sure that you are referring to the correct plan and you know that when this particular plan was reviewed. So the plan's USP, or the unique selling point, as the company states, is the guaranteed payouts of 8.5 to 9.5% and then the 100% amount paid at the time of maturity. The reasons why the company says that you should buy is, of course, because of these guaranteed benefits, guaranteed lump sum that it is assuring you at the time of maturity, and the 100% sum assured majority, which is paid at the end of 20th year. This means that the policy term is actually 20 years. Now, what it is also saying is that, and it is giving you a reason to buy, which is actually hard to digest, that it is offering you different premium payment terms. The premium payment terms is 5, 7, and 12 years, which means that it is a limited premium payment term. And then you also receive tax benefit, and which we know very well that this is one of the reasons why life insurance policies sell in large numbers. The reasons why you should not buy this particular policy I have covered in my review, and what are the alternatives that one can use is also what I've covered in this video. So let's move ahead and try to see how this particular plan works. So I've taken this case study right from what company has publicized on its website, that we have a guy who is 35-year-old named Mohan, and he is looking for an income protection plan and uses this particular savings plan. Now he's going to be using the maturity benefits for the future expenses like his daughter's higher education and marriage, and he is only looking for a sum assured of around 11,87,648, for which he's planning to pay the premium of 1 lakh rupees for 12 years, which means he will actually be paying 12 lakh rupees, and he will be getting benefits of something during the course of the policy, as well as at the time of the maturity of policy he will get 11,87,000 rupees. So what really happens is, from the first year onwards till the 12th year he pays 1 lakh rupees as the premium, and then from 12th year onwards, or end of 12th policy year onwards, he starts getting 1,12,827 rupees annually, which, as you can see, is 9.5% of sum assured at maturity. He continues to receive this till the end of 19th year, and after that, at the end of 20th year, he receives the sum assured at maturity 11,87,648, and this particular policy terminates. If we see a graphical representation, you can see that Mohan is actually paying this premium for 12 years, and during the maturity payout period he is getting that amount of 1,12,827, and at the time of maturity on 20 years he is getting this particular lump sum payment. However, the thing to note is that the life cover is available for Mohan only for the first 12 years of this particular policy. So if something untoward happens to him during the first 12 years is the only time when his family will be able to get benefit out of this policy. And in case of sad demise, before 12th policy year, his family will receive 11,87,648. However, in case of his sad demise during the 12th policy year, his family will receive 12,60,000 rupees. Now, a couple of red flags over here as well, that he's paying a sum of good amount or a handsome sum of 1 lakh rupees per year, but he's getting a paltry coverage of 11,87,648, which seems to be grossly insufficient for somebody who can afford this kind of a premium. The second thing is the company is talking about the future expense or maturity benefit to use future expenses, and it is not talking about family's financial security, which should be the first and foremost focus when you're taking an insurance plan. So what I've done is, next I've taken these values and I've done some calculations and tried to find out what is the true returns that you are getting out of it, and what can we infer based upon that. So going to the calculations tab, I have put all these values over here. You can see I have put the details over here, what we're trying to do. I've said that we're going to be starting to take this policy from 1st of January 2022. From first year till 12th year, there's a premium being paid, and I have put the GST value over here as well, because if we need to find the true returns, we need to make sure that we're trying to calculate it based upon how much is the amount that he will actually be paying out of his pocket. Now, as the company has stated, from the end of 12th year onwards, which means the 13th year or the beginning of 13th year onwards, he's going to get some money, and then at the end of the 20th year, which is the beginning of 21st year, he will be getting the lump sum amount. So the overall cash takeout from his pocket, in case there is no return, there is no tax return benefit that is going to be taking, is what is noted down on your screen. You can pause it over here, and along with that I have also put that in case he takes 10%, 20% or 30% tax return benefit, then how much is the actual amount he will be paying from his policy, and what will be the benefit that he will be getting out of it. So in total he has paid 12,29,250, including the taxes that is there, and the amount that he is getting in total is 20,90,264, which means a net extra amount he's getting is 8,61,014 rupees. However, all of these figures do not matter any longer. It doesn't mean anything, and why I'm saying so you will find out in a short while. So we're talking about the returns without tax benefit. So if I put an XIRR formula upon these values, that there's a cash flow out that is happening for first 12 years, and thereafter the money is coming into the pocket. So the XIRR value that comes along is 4.28%, and that's the return that he will be getting in case he is one of those guys who is not taking or who is not claiming any tax benefit. Now, in case he is one of the guy who is into 10, 20 or 30% tax bracket, then the return will be moving from 4.28% higher up to 5.1%, 6.12%, all the way up to 7.23%. Now, over here, this is what attracts a lot of people, saying if you are able to generate, if you are in a tax bracket of 30%, then you will actually be able to get 7.23% return, which seems to be decent return. And we will keep that in mind when we go forward and we try to evaluate whether or not this policy should be taken. But in most cases, just have a look at saying, will you be able to avail this 30% tax return benefit every year for the next 12 years? Because there are many other avenues which are much more beneficial than using a life insurance policy to get a paltry cover of around 10 lakh or 11 lakh rupees along with some returns. So what I've done next is that what can he do? So what he can do is, I have tried to use Bharti Axa's other policy, and I've tried to find out that Bharti Axa has got a Flexi Term Pro, which is a pure term insurance plan. And why I have chosen this is, I've assumed that he likes Bharti Axa as a company, and hence I've not gone and said go and buy an LIC policy or go and buy a Tata AI policy. Let's try to see that if he invests in Bharti Axa's Life Flexi Term Pro plan, what really happens. So what I've done is I've used the same values, which is he is 35 years old, and the policy term is 20 years, and the premium payment term is 12 years, which means that he will be paying the premium only for the first 12 years. However, the policy term of 20 years here means that he will be having the coverage available for the 20 years. The amount of premium that I have taken is 1 crore. So it is no longer that 11,87,000 rupees that he had taken earlier. I have moved it to 1 crore as a pure term plan. And what that means is that the premium that he has to pay is around 18,390 rupees. Along with taking this plan, what I've also done is I've taken a rider which is a waiver of premium in case of critical illness, which means that in case something happens to him, in case he is diagnosed with a critical illness during the course of the policy, then his future premiums will be waived off, and he need not give that. His family will be getting the cover or the benefit available for the rest of the policy. So what really it means is that instead of taking the plan, the Bharti Axa Elite plan, what I've done is that I've taken this Flexi Term Pro plan, and as you can see that the premium over here is meager 18,390. And what we are going to be doing over here is we'll try to figure out why is this a better option than the policy that has been noted previously. So in this sheet, what I've done is I've used the values that we have just seen on the previous screen, and I've tried to demonstrate why is this a better plan than the Bharti Axa Elite Advantage plan. The first thing that you can see is that the sum assured over here is 1 crore rupees as opposed to 11,87,000 rupees, and the life cover will be available till 55 years. In that case, the life cover was available for 35 plus 12 is equal to 47 years, whereas that has now been increased for next 8 years, and hence he will be getting the life cover available for the longer duration. What we are doing is we have kept the premium payment term as same as 12 years, and the premium we have said that is 15585. Now one thing to note is when it comes to the pure term plan, the GST that is charged at 18%, which many people think that when they're taking the other plan, the GST charge is just 4.5% for the first year and 2.25% for the second year onwards. But this particular page will hopefully help you understand why this is still a better plan. Now I have done the same thing as I've done in the previous particular sheet, that I've put all the dates over here from year 1 till year 21, and as you can say that as he is aging from 35 to 55, his death benefit is remaining as same, which is 1 CR. He's paying a premium of 18,390 in this case. So over here the premium amount is 18,390 because I've put 18% GST on 15,585. And the surplus premium, and this surplus premium is actually the premium being paid in case of Bharti Axa Elite Advantage plan minus the premium that he's paying over here is approximately 86,110 for the first year, and for the next year onwards the amount comes to be 83,860. So this is the amount that he's able to save by getting even a higher death benefit for a longer duration of time. And what I have said is that if he takes up this amount, only the amount 83,860 that is now in his hand, and deposits in an instrument which is giving him just 6% of returns. Now let's understand that he's looking to get money after 12 years, and hence ideally one would if you go to a financial advisor, they would advise him to deposit the money in equity, but I'm considering a very safe instrument of investment at 6%, and what he will get after the end of 12th year is that he will be getting 14,99,000, which is approximately 15 lakh rupees after the end of 12 years is the amount that he will be able to generate by investing this particular amount. The next thing that I've done is I said that okay, he was actually interested in getting a lakh and 12,000 rupees for the next few years, which is next 8 years, and thereafter he wanted the payment or lump sum payment at the end of 20th year. And if he wants to do that with this particular amount, what he needs to do is he again needs to deposit this amount or invest this amount in an instrument which is giving him a 6.19% of return. So I've used the rate formula to determine what is the value that he should be able to generate, and actually he will be getting a lot more than what I have put over here. But nevertheless, if he keep on investing his sum at 9%, he will be getting the same particular advantage that he was getting as part of Bharti Axa Elite Advantage plan, but he will get a higher death benefit and will get for a longer time. So what are the benefits of using this plan? Let's reveal the secret. The first is the 10 times the insurance cover that he is getting. The second is that he will be able to take out his money anytime he wants. So when you're taking the Bharti Axa Elite Advantage plan, one of the problem that is there with the life insurance plan is the surrender value. So you get a very paltry surrender value if you ever wish to remove the plan or take away the plan or take away the money that you have put so far in the plan. The premium waiver in case of critical illness. So you remember I said that we have taken one more thing over here, which is in case he is diagnosed with one of the critical illness, he need not pay anything further. So so his family security will still be there, and to a large extent in case there is a health issue that he's having. And the last secret is that he will be getting higher returns. Now I talked about 6% returns or investing at 6% return. Let me just show you that if I invest it at, let's assume 10% as an average return, equity is on an average supposed to be giving you 12%, and if he's investing this at 10% return, then after the 12th year or at the end of 12th year, he will be getting 19,72,608, which means that if he invests this amount at just 1.68%, his goal will still be realized, and he will continue to get a higher insurance cover along with longer time and the critical illness benefit that I have earlier talked about. Now next, look at the eligibility criteria of these two plans. You can pause the screen and have a review. There is nothing special that I want to cover over here, so I'll summarize it by giving them an EPM rating, and Every Paisa Matters will rate this as 4 out of 10. And why I'm even giving it 4-star is, the first thing is that it is giving a decent return in case somebody is claiming 30% tax bracket, because if you would remember in the calculation we saw that it is giving 7.23% return, which are decent returns if somebody is able to claim the benefit of 30% tax benefit for the entire 12-year period. The second is there are a number of cases where people are not eligible to take term insurance, and hence the only recourse for those people is to take these kind of insurance. And as you can see that you need to pay the price for getting the benefit, because over here you're paying approximately around 1 lakh rupees for a cover which is around 10 lakh rupees, whereas in the case of the term plan you're paying a premium of just around less than 20,000 rupees, and you're getting a 1 crore cover, and that too for a longer duration. So this particular plan of course gives you very poor returns, and it is not actually giving you enough coverage. And before you take any particular insurance policy, make sure that you first identify what are the insurance needs of your personal self as well as of your family, and only then you need to go and take an appropriate insurance plan. I've covered in many videos that term plan is always a better plan. In case you like this video, please hit the like button, subscribe to the channel for more such informative videos in the future, and do not forget to click on the bell icon to get the notifications so that as soon as a video is released you are notified about the same. We'll be coming back soon with another video. Till then, bachate raheं, kamate raheं, because every paisa matters.